Variable costing for management analysis. What is variable cost? Variable cost can be defined as expenses which keep changing in proportion to the activities of a business. Variable costs can be calculated as the sum of marginal costs over all units produced. Variable costs form one of the essential components and an important management tool in calculation of total cost. Ito yung mga gastos o yung mga patuloy na nagbabago na presyo o gastos depende sa proportion ng aktibidad sa negosyo. Kinakalkula din dito yung mga kabuuang halaga sa lahat ng nagawang units. At binubuo rin to ng mga mahalaga at importanteng kagamitan sa pamamahala ng pagkwenta sa kabuuang o pangkalahatan na gastos. So what is variable costs analysis? Variable costs play an integral role in break-even analysis. The break-even analysis is used to determine the amount of revenue or the required units to sell to cover the total costs. Dito naman yung ginagamit na bilang break-even analysis para malaman natin kung gaano kadami yung kita o income ng isang produksyon o ng isang kumpanya o yung mga unit na mga kailangan pang ibenta para pag pinagsama-sama to, ma-compute ang kabuuang gastos sa production. What is variable cost in managerial accounting? A variable cost is an corporate expense that changes in proportion to production output. Variable costs increases or decreases depending on the company's production volume. They rise as production increases and fall as production decreases. Examples of variable costs include the cost of raw materials and packaging. Ito yung variable cost na sa isang korporasyon nagbabago nga, o yung output ng production sa variable cost na tumataas o bumababa depende sa dami ng nagawa na units o nagawa sa production ng isang kumpanya. Tumataas sila habang tumataas ang production at bumabagsak din habang bumababa ang production. Halimbawa na lang dito yung mga nakapaloob ay yung mga raw materials at sa mismong produkto at ang mga kailangan para sa packaging.
Awesome screen, awesome camera, long-lasting battery life. Awesome screen, awesome camera, long-lasting battery life.
Awesome screen, awesome camera, long-lasting battery life. Awesome screen, awesome camera, battery life. Awesome screen, awesome camera, long-lasting battery life. Awesome camera, awesome screen. Charging super steady.
Long-lasting battery. Budgeting. So let's proceed. Budgeting is simply the process of creating a plan to spend your money. The process of calculating how much money you must earn or save during a particular period of time, and of planning how will you spend it. So budgeting is simply a planning process. So if you don't have enough money to do everything you would like to do, so that you can use this type of planning process in order for you to prioritize and focus to the things you want to spend to. So budgeting also have the advantages. It increases the probability that the company goals and objective will be achieved. Problems can be anticipated and avoided by possible remedial action. Helps in defining strengths and weaknesses on which the entity can concentrate, link with the personal targets, and improve staff motivation. Lastly, better coordination of activities and different parts of the company. So next, let's proceed to the disadvantages of budgeting. The disadvantages of budgeting. The disadvantages of budgeting. So the first one is, planning is often seen as unnecessary additional work and thus receive the lower priority. Secondly, staff may be demotivated if the targets set are too difficult or too easy to achieve. lower flexibility. Next, stock usually aim to the target, not exceed it. And lastly, fulfillment of one objective while other meaningful metrics are present. So, that's the advantages and disadvantages of budgeting.
Evaluating variances from standard cost. A variance is a difference between a standard cost and actual performance. There are favorable and unfavorable variances. A standard cost variance is the difference between a standard cost and actual cost. Standard cost can provide information that is useful in performance evaluation. Standard costs are compared to actual costs and mathematical deviation between the two and term variances. Favorable variances result when actual costs are less than the standard cost and vice versa. The following illustration is intended to demonstrate the basic relationship between the actual cost and standard cost. AQ means an actual quantity, AP means actual price, SQ means standard quantity, and SP means standard price. There are two total direct material variance. Number one is materials price variance. As you can see, standard price minus the actual price multiply the actual quantity. So standard price for materials purchased and the amount actually paid for those materials. Next is materials quantity variance. So as you can see, standard quantity minus the actual quantity multiplies standard price. Standard quantity of materials that should have been used to actual quantity of material used. Standard costs have advantage. Number one is budgeting. Budgeting is always composed of standard costs since it would be impossible to include it in the exact actual cost item on the day the budget is finalized. Number two is inventory costing. It's extremely easy to print in showing the period and inventory balances. The result does not exactly match the actual cost of inventory, but it is close. However, it may be necessary to update the standard cost frequently. Overhead application. Overhead application, if it takes too long to aggregate actual costs into cost pools for allocation to inventory, then you may use a standard overhead application rate instead and adjust this rate every few months to keep it close to actual cost. Price formulation. Price formulation is when a company deals with customs products, then it uses a standard cost to compile the projected cost of consumers' requirements, after which it adds margin. So, standard costs of problems 2, cost plus contracts. Cost plus contracts, if you have contract with customers under which is customers pays for your cost incurred plus profit, then you must actual cost or per terms of in contract. Next is drives inappropriate activities. A number of variances reported under standard costing will drive management to incorrect actions to create favorable variances. For example, they may buy raw materials in larger quantities to order to improve the purchase price variance, even though this increases the investment inventory. Next is fast-paced environment. A standard costing assumes costs do not change much in the near term so that you can rely on standards for a number of months or even a year before updating the cost. Slow feedback. A complex of variance calculations is an integral part of standard costing system which the accounting staff complete at the end of each reporting period. If the production department's focus on intermediate feedback of problems for instant correction, the reporting of these variances is much too late to be useful. Next is unit level information. The variance calculation that typically accompany standard costing report are accumulated in aggregate for a company's entire production department and so are unable to provide information about discrepancies at lower level, such as individual work cell, batch, or unit.